Ladies and gentlemen, thank you. At the beginning of this seminar, Governor said that I'll be giving a thorough, going through thoroughly the operational framework of ECB monetary policy. And the head of communications told me that it's 15-20 minutes, so comprehensive in 15 minutes. If I look at the audience, I see plenty of bank economists for whom this is quite familiar. And I see representatives from the media who can always take 38 slides in 15 minutes. So I'll do both. I'll do it in 15-20 minutes, but I'll do the 38 slides. So, okay, I've been giving presentations in academics conferences or policy seminars like this for a quarter of a century and dozens of times, and I've always started with the usual disclaimer. Today, when we had the board meeting, we were discussing the responsibilities, and I am responsible for market operations here, which means that I'm responsible for monetary policy implementation. I realized that, well, I really needed to say, if I do express any views here, they will be the views of the Bank of Finland. Naturally, that doesn't mean that our governor needs to share them when he goes to the governing council, but anyway, so that was a joke. The contents, it's in three parts. Well, past, present, and future. So, okay, let's start with the pre-crisis. I don't dare to say normal monetary policy implementation because I don't know what is normal. The ECB framework has been in crisis mode for bulk of its existence. So I would say pre-crisis monetary policy implementation. Let's go through this just to be able to understand what failed during the crisis, or how I see what are the open issues for the future. So, Niku. The basis for banknotes, for central bank balance sheets, is the banknotes. There are 1,200 billion euros worth of banknotes circulating around the world. It's a huge number. They are not disappearing very soon, at least. If you divide that by the number of inhabitants in euro area, you get something like 4,000 per each of us. I have 2 kids, so our family should have 15,000 euros in cash. Well, we don't, but somebody is having. So anyway, we can do monetary policy even without banknotes. We take this as exogenous variable for us, but it is there. So it is the basis of our balance sheet. It's our liability. So the banknotes goes to the world by banks. Banks get them from us, and against what? Well, the banks have They have the accounts with us, and the commercial bank's accounts with us. It's what I call liquidity. It's the balances on the commercial bank's accounts with us, and the banknotes go to the world via the banks, and we draw down their balances with us, and that is the first thing why there is a demand for liquidity. Secondly, there is the demand for liquidity is enlarged by the minimum reserve requirements. So banks need to hold part of their liabilities with us, and that's mandatory. So, for example, in 2008, for example, the demand for liquidity was here something like 900 billion euros. And where did that come from? Basically, the first source is other autonomous factors. Autonomous liquidity factors is something not related to monetary policy, like the banknotes. But there are other types. For example, when we buy FX or gold, we buy them with remunerating the commercial bank's account with us. So that creates liquidity. Half of the liquidity need was supplied via these autonomous factors. Actually, also it includes our purchases of euro sovereign bonds, which we did well from the start already. So QE was an innovation, but it is sovereign purchases for monetary policy purposes. We've always been buying sovereign bonds, but for investment purposes, or just to provide liquidity to the markets. And the rest of the gap, it was filled by our refinancing operations. So mainly, mostly by our weekly operations, main refinancing operations to the banks, and the rate of this lending is the policy rate of, and was the policy rate of the ECB. So basically, with the rate used in these operations, we steered the short-term rates in the markets. And as you see, the liquidity supply and demand were almost one-to-one, except from starting from the turmoil when you see slight deviations there. So the liquidity conditions were neutral in this sense. Taken from a commercial bank's perspective, here is the demand for liquidity for it. So as long as its balances at the central bank are below zero, they need to cover it with marginal lending. So the rate, in short-term rate, is at the marginal lend rate. If you have fulfilled the reserve requirements for the entire 1 month's maintenance period for reserves, you have excess liquidity with the central bank, and you are paid with the deposit rate. So the rate goes down there. If within the 1 month reserves averaging period, so you have the mandatory reserve requirement, but you can average over 1 month's period. So you can have, if your minimum reserve requirement is 100 million, you can have 50 today, 150 tomorrow. So there's flexibility, except from the final day of the period. So in meantime, it is approximately at the policy rate, the interest rate will be. It's approximately, because it's if you do the backward induction mathematically, you see that it's in the midpoint of the interest rate corridor, which is called the corridor is the spread between a marginal rate and deposit rate. So it's the midpoint, but it was always coincided with the policy rate. Now this is the theoretical without the dynamism of the maintenance period and without liquidity uncertainty, which there always will be. You get from this theoretical to the actual by doing easy calculations. So from this equation, you easily see that the true demand is like this. You easily see, well, it's academic term for I calculated more than 4 weeks to get this. And it's already 10 years ago that I did it, so I couldn't redo it anymore. So, but anyway, the intuition is there that the shortest market rate, the Ionia, it decreases monotonically with excess liquidity. But because of the averaging period, there is no three flat parts of the demand curve. If you are without liquidity, the rate is at the marginal rate. If you have excess liquidity, too much excess liquidity, the rate is at the deposit rate. If you are at around neutral conditions, there is also a flat part due to the averaging provision. And what the central bank, what the ECB, what us, we were trying to do, we were supplying liquidity, trying to be on this flat part by doing variable rate auctions, where we set the volume to be here, and then the banks were bidding competitively, and the rate got somewhere closer to the refinancing rate. Here's what it is, what it was empirically. So we were giving liquidity which was close to having neutral liquidity balances, and the spread between Ionia and the policy rate was very small, and it was stable. So monetary policy making was rather easy, especially as all the risk premia in the markets were almost negligible, or at least stable. Here we have Euribor minus Euribor. So the unsecured minus the secured interbank rate. So this spread here contains both the liquidity risk and the credit risk from the banks. And as you see, it was almost non-existent. So in this world, what monetary policy making was that governing council, well, it was before Rehn's time, but the governing council then they decided on the rate that is consistent with the inflation target. We, the implementation guys, made sure that rate still really existed in the market, And as the spreads were there, all the long rates were basically expectations on where the monetary policy stance goes in the future. So relatively simple. It was based on three paradigms. So first, that we can really steer the operational target or the market rate to our operational target, which never was publicized, but it was actually, everybody knew it was Ionia. Then also, the second paradigm was that all the rates that are more directly relevant for monetary policy transmissions should carry stable premia. For example, in Finland, the Euribor is by far the most important reference rate. So it carried a stable premia over the policy rate. And thirdly, we thought that we can always adjust policy stance enough by shifting the policy rate. So we didn't think that zero low bond would be binding. And all of these failed during the crisis. So, first of all, our control over the operational target was complete here. Even though it says that it shows that there is some volatility, it is just because of the fact that there are so many observations, and there is one observation for each maintenance period where there is volatility, because within the maintenance period there's final day volatility. But indeed, the Ionia was really close to the target always. There was some volatility during the turmoil time, so between August 2007 and the failure of Lehman Brothers. But only after the failure of Lehman Brothers, we got into a situation where we really didn't control the shortest rate anymore with our policy rate. Second failure, okay, the money market risk premia. As you all know, they shot up first with the turmoil and truly with the liquidity crisis we had or global financial crisis that we had after the Lehman failure. So certainly, if we could control the shortest rates, the Europe, even if we could control the Euripo, there were like 2% percentage points premia over that. So it meant that on this day, it meant that when after the Lehman Brothers failed, it was felt like we did 4 or 5 interest rate hikes in a day under conditions when everybody needed a monetary policy easing. Okay. Also, as you know, the spreads between sovereign yields throughout the euro area started to increase, and there was the doom loop. So when the rates of sovereigns, the refinancing cost of sovereign was rising, it went hand in hand with the financing cost of banks, which naturally is carried out on bank lending. Otherwise, banks would be making losses. So there were huge differences between average lending rate of new loans to businesses between the core and periphery. And as you saw, even when the monetary policy was further eased, in the periphery, the monetary policy wasn't transmitting, so that was a failure which we also had to address. And finally, the ZLB, the Taylor rules suggested that in euro area or United States, there were long times where the policy rate should have been negative. So the ZLB certainly was an effective boundary for us. What was did to address the first failure? Well, we went from the variable rate tenders to fixed rate full allotment operations, which meant that, okay, we didn't anymore give the amount of liquidity that we thought that was the neutral one. We just said that, okay, we fixed the price for liquidity, and banks, you decide what is the liquidity in the euro world. And it meant that the excess liquidity, in a way, exploded to 200 billion. Well, now it's not a big number, but then it was. As a result, the liquidity risk, the Euribor spread got down. So basically, we by giving banks the pledge that you can get whatever liquidity you need from the central bank at a fixed rate, if you have, as long as you have collateral, you can do it. So I got 2 minutes sign, and I'm in well, you didn't take into account that Aki was taking my time. So okay, well, let's then skip this one. Okay, the liquidity. When we went to excess liquidity, we got into another flat part of the demand curve. So Ionia got to be stable, but at levels which were closer to the deposit rate. Having excess liquidity is costly to the banks because they borrow with the main refinancing rate, they deposit it with us with one, then it was 1 percentage point lower. So banks wanted to get rid of the excess liquidity. They back in the early 2009 they started paying it back to us, but then we started another action. We invented the 1-year operations. So we promised to give fixed rate liquidity for 1 year for the banks, and the banks went again to huge excess of liquidity. This time for, okay, so when the liquidity got drawn back, we saw volatility increasing because the excess liquidity goes with this theoretical or this demand function as it shows. We got into place where the volatility of short-term rates returned. Then we got to the 1-year operations and excess liquidity with them, and then we got to the second plateau where and still the Ionia is pretty stable at the deposit facility rate. Another, the second failure was addressed by the targeted long-term refinancing operations. So when we didn't see the monetary policy being transmitted in the periphery, we started the targeted long-term refinancing operations, giving with the central bank set rate, huge amounts of financing to banks. What means targeted is if it was used for loans to real economy, except from housing loans. Then we started the non-standard measures to address the failure number 3, the ZLB. So we lower the short end of the yield curve by going negative. The mid part of the yield curve, we lower it by forward guidance, where we say that, for example, rates will be at the current level until at least through the summer of 19. And then with quantitative easing, by buying longer dated bonds, we directly push down the long rates. And as a result, the whole yield curve shifts down. Now, this is already seen. You've already seen this. This is the shadow rate by Tomi Kortela, and as you see, the result was that we got with this measure to the levels which are comparable to what the Taylor rule had suggested for those days. Now, the new normal. I'm finishing in a minute. What is the new normal? I don't know. Open questions. Tender procedures. Well, we've been having fixed rate full allotment there already for a decade. Can we finally accept that it is a normal procedure? It's easy for us to say because we are the only central bank in the world that used the fixed rate full allotment procedures already before the birth of the euro system. So for us, it was a more normal procedure, and we see it as potential there. Floor versus corridor. Well, the corridor system that prevailed at the pre-crisis times needs to have liquidity or close to neutral liquidity conditions, whereas the floor means that you need to have huge excesses of liquidity. With our current balance sheet, there will be a huge excess of liquidity unless we start either buying, not selling, buying assets or trading liquidity, for example, by issuing our own papers. If you really wanted, for some reason, to go quickly back to the corridor system. Balance sheet management. Well, we all know that we already hit the ZLB once. We know that we probably are going to hit it more frequently than we thought we would. So, as the governor said, I guess quantitative easing and TLTROs types of tools, they are now part of our tools that even if we said that we discontinue them, they are in the box, and everybody knows that if the times come and we need them, they are always easily reusable. Well, then, counterparty and collateral considerations. For that, I need some slides. I skip these because I don't have time to go over these because they were really interesting slides. This is the early slides continued with the crisis types, and as we saw, the red line is still the liquidity demand, and with the long-term refinancing operations, we got to the excess liquidity, and now mostly because of the QE, there is huge excess of liquidity, like 1,800 billions. So to get rid of that, if you wanted to go back to the corridor system, you need to get rid of the excess liquidity, and to get rid of that, well, okay, it takes time. These are purely hypothetical. If we've said that we do reinvestments, we do it, the longer we do it, the longer it takes these assets to mature. So if there is a need for excess liquidity to be drained by 1,800 billion only with maturing operations, you really need to wait for a long time. Okay, but then again, the bank's notes probably will increase in the future as well, so you get some help there. But we are going to be in excess liquidity for quite a while, and if we wanted, we can continue with the floor system in the future relatively easily, at least if the banknotes keep on growing. What was problematic here? Well, this is indeed my final slide. So here we have main refinancing operation, main refinancing rate, deposit rate, IONIA, general collateral pooling, and German repo. What is the point here? Just to say that, well, when we started quantitative easing in 2015, we've been buying safe assets like German bonds, German government paper. They are dear. There is a lack of them. In the US, people think that when Fed does QE, it increases safe assets because it increases the Fed balance sheet. Fed balances at the Fed, which is the safest asset in the world. Here, we do the same. When we buy bonds, we buy them with the safest asset in the world, our liquidity. But it's safe asset only for banks because the banks have accounts with us. Every other investor in the world doesn't feel it as a safe asset because they need to go via banks. And that's why not only we've been buying the safe assets, the bonds, we've been creating a call for safe assets, German T-bills, German repo rates, because the rest of the institutions that have been selling these assets to us, they've gotten liquidity, but they don't want to take the bank risk, so they've been using repos or buying short-term German paper, which has been pushed way beyond our policy rate, which is now the deposit rate. So here is one of the issues for the future. Do we need to create a safe asset by central bank issuing something, or do we need to widen the counterparty set in order for other players than banks to get a safe asset at the central bank? Okay, thank you.
Okay, thank you for inviting me. So I have an opportunity to give answers for these open questions, so that the right answers, I guess. Well, actually, I only have a view on some of these issues. And first of all, I guess that if there's a message or kind of the clear comment is that when we talk about the kind of the future setup of the monetary policy or kind of the monetary policy framework and how to go to the normal kind of the policy, it's the kind of the guidance or the information what's the key really, because the uncertainty, as we know, it's not it's hated in the markets, and that's something that we really don't like. And now, as I see that, of course, the ECB has used the opportunity to give guidance for the rates recently and give a kind of quite long-term guidance how to deal with the monetary policy. But as it comes to the way how they will proceed, what kind of measures they will actually take, there's no guidance as such, I think. And whether deposit rate will be used or whether it will be marginal rate or so that there's kind of open issues, and liquidity is, of course, one of those issues. So I guess that the information of the path towards the normalization of the normal times would be crucial also, so that not only the guidance for the interest rates as such, but also the overall way how to proceed. Since I think there's a lot of uncertainty in the markets that what are the steps that the ECB will first take towards when they will start to normalize the monetary policy. So there's still room for kind of the further guidance for the ECB, how they will proceed. And as we know that it will be very difficult to forecast that what the economic conditions as such will be, so that whether there's need to raise rates in the next autumn or not. But it may be possible to give clear guidance that how the central bank will proceed in the future, so that what are the steps in a way. And that may be kind of such an information that will not change when the economic environment will change. So there's room for further guidance. And one of the issues is also that the long-term kind of the view on the rates. As we know that the Fed has its dot plots system, and there's kind of the clear view that how the central bankers think what's the kind of the long-term neutral rate. And now you've done a lot of analysis, and there's kind of picture that in which range the neutral rate will be in the future. But we don't have a kind of clear view that how the central bankers actually, or the governors, see the situation, that whether the long-term neutral rate or the long-term rate in the euro area will be 2.5 or something like that. So I'm in favor kind of not only to give information about the steps that how to proceed towards the normal, but also that to give them a more clear view of how the governors think about the interest rates in the future, in the long term. But going to these questions, I think that there's the uncertainty issue, and I think that if you go to question 2, since I don't really have the clear view about the question 1, but as it comes to question 2, I think that the selling assets would create more uncertainty going forward. So that I definitely would be in favor for draining liquidity, as I think that that would be more safer and kind of the more certain view for the market, so not creating that much uncertainty. And also I think that the liquidity deficit would be a kind of more normal position as such, and at that way a better position. Well, you already answered to question 3, basically, so that there is this toolbox, and there is it, so that it will not change clearly in the future. So that as such, we know that there's a lot of tools that the central bank can use, but we don't know that how they actually will use, or what they think in the future, that how they will use these tools when they are proceeding towards the more normal times. And there I think that there's more room for information going forward. Question 4 is also rather difficult as such, so that I don't have a clear view on that. So that I would clearly give only one clear comment, and that's that please just give kind of the clear guidance towards the future and what kind of steps you are about to make going forward. I think that the Fed, for instance, made quite clear kind of or presented quite clearly that how they will proceed when they will normalize the rates. And the ECB has also done a kind of rather good work when kind of giving guidance of the rates, but I think there's still room for kind of the further guidance of the steps as the normalization will begin. Thank you.
Okay, I propose now that Thomas please come here, but I give the floor to the audience to ask questions or any comments at that point.
Let me first start by replying to Reijo that certainly you said that there should be more guidance, not necessarily on when the rates are hiked or how much they are being hiked, but how it will be decided. And I think the first part of this seminar was almost on exactly on that issue. Probably the ECB could clarify its reaction function by, for example, stating what close but below 2% really means. That was the title of the previous. But then you said that the ECB Governing Council should also do what the Fed does with the dot plots on the longer run neutral rate, if I understood correctly. So there I would say that because the answer depends on where the natural rate is. So if you give me the natural rate, which I thought that from earlier today that it's somewhere between -1 and plus 1.8 or something. So if you give me the correct estimate for the natural interest rate, I'll add 1.9 to that, and there's the longer run rate.
Good. Any questions at this point? We can. Okay, Niku, please.
Well, I don't know where the cash is.
Okay, but about the zero low one once more. So I think it was always clear, right, to everyone that the zero low one is not exactly at zero, right? It's it's okay to go a little bit below. That was always clear, I think. And indeed, policy rates have been negative, and I think they have been perhaps a bit more negative than what many people thought would be kind of feasible. Before the crisis or before these unconventional policies. So my question is, okay, related to this, it was interesting to know that when you showed the banknote evolution, I mean, it doesn't seem to be any correlation with the negative policy rates now. So I mean, that's the main concern, that if we push policy rates much below zero, and then everybody start to get lots of cash. So we haven't seen that. Have you seen some other sort of worrying, worrying signs in the economy with negative policy rates? So what I'm kind of asking for, would you say that it would be okay to go perhaps substantially, substantially more below zero than what we have done so far?
We don't see huge increases in the demand of cash due to negative rates, mainly because the rates are not negative for households. And if the rates are not negative for households, but the financing or the lending rates of the banks have gone down, it means that the margins that the banks enjoy have gone down. And depending on the banking model that the bank uses, it could be that some banks have been making even losses, if not only reduced profits due to this fact. And there's the limit. So if we think that the household deposit rates cannot go negative, there is a limit, because banks, at least some banks, start suffering and start losing their business model. So that would be the cost of going more negative. Or then the banks would need to push the household rates to negative, and then we indeed probably could see some shifts in the demand for banknotes, which will then mean deposit withdrawals, which would again be problematic for the banks. So actually, it is the banking system that is hindering from going deeply into negative territory.
Thank you very much, Tuomas. Now let's thank Tuomas and Reijo. And then, before enjoying some refreshments, the Governor Rehn would like to conclude this seminar. So thank you very much for your questions and active discussion indeed. Thank you.
Thank you, Elisa, and thanks to everybody for coming to this mini-seminar, which was partly extempore, but in fact we had most of the research work already prepared, so we thought, as we have had some internal seminars of the board or our research department, we thought why not widen this discussion and present these, to my mind, excellent papers, and thanks for the comments, all of them for a wider audience. And you may recall that the motivation of this seminar stems actually from at least two directions. One is that one is quite obvious, the normalization process of the Eurosystem ECB monetary policy is moving on, and therefore it is of paramount importance to deeply analyze the best possible options of going forward in this process of gradual and prudent normalization of monetary policy. And the second one is that, which is more particular to Finland, but might also apply elsewhere as well. I find that the discussion on the euro in Finland in recent years has centered very much on issues not actually related to monetary policy proper. In other words, the discussion has centered on crisis management, on fiscal policy, on institutional reform, but less on monetary policy proper and its determinants and frameworks. And the goal of this mini-seminar was to start to fill this half vacuum that we have in the, say, broader debate, broader public analytical debate on the monetary policy stance, monetary policy normalization, monetary policy frameworks. And in today's presentations and comments, which I will not repeat here, but we have found out that there seems to be a relatively broad consensus, if not of a secular stagnation, but a secular decline in interest rates, which obviously has an impact on the economy, on monetary policy. We have heard important insights on symmetry versus asymmetry in interpretation of the objectives of monetary policy or price stability target. And we've heard very valuable insights on its relation to the reaction function. And I think we have to continue this work. And I take from all of the presentations and comments as a takeaway the need to have not only a steady hand, but also a creative mind when reflecting future steps in monetary policy. In this sense, Tuomas' presentation was very illuminating, and for instance, these issues, these open issues, 4 issues here on the screen, are issues that form at least a very significant part of the policy and analytical agenda of ECB monetary policy making going forward. So I would like to warmly thank the presentators and commentators, Mihaela Schmöller, Niku Määttänen, Markus Haavio, Aki Kangasharju, Tuomas Välimäki, Reijo Heiskanen, and also to thank Jarmo Kontulainen and Janisa for organization, and all the others who have contributed for this, as well as Elisa for very rigorous moderation, which enables us to conclude pretty much in time. But before ending and before turning to the reception, I just want to inform you that we will continue this reflection on the medium to long-term monetary policy frameworks, which will contribute on our part to ECB monetary policy making. And we have actually one future anchor in terms of reflection process already decided, which is that next June we will organize an international research seminar in Helsinki, focusing on monetary policy normalization and frameworks, as well as the Eurozone reform, which hopefully is moving by then. And I think we have the dates already. I wonder if Jarmo recalls. It's 18 and 19 of June.
Yes, on that week.
Yes, it's the week, early part of, as everybody in Finland knows, early part of the midsummer week. So we will we will spend the beginning of the week in very intellectual conditions and then conclude the week in hopefully very sunny and perhaps less intellectual conditions. In any case, the research seminar will take place in June. You are all invited for that. And in between, we intend to organize without any pre-commitment, because we don't like that anymore. So we will organize either external or internal mini-seminars on these issues in order to prepare ground for this international research seminar, so that we can fully contribute to the reflection and making of monetary policy in the Eurosystem. So with these words, thanks to everybody, and you are now invited for a glass of wine or whatever you prefer in the reception next door. And thank you, and see you again in these terms. Thanks.